Hey, I'm Jusko from ProudMoney.com. In this video, we are going to look at how to increase your credit score quickly here in the year 2021. And then we're also going to look at how to increase your score more slowly over time, so it is sort of solid for the long haul. But before we do any of it, I'm going to ask you to please subscribe to this YouTube channel if you have not already. And if you have already, I thank you for doing so. So we're into 2021, and perhaps one of your New Year's resolutions is to get that credit score up. This video can help you do it. Doesn't necessarily have to be as a New Year's resolution anytime here in 2021 or any year. Most of these tips and tricks and tools will help you. So we're going to look at how to move the needle quickly, or at least as quickly as possible, in terms of increasing that credit score. And then we're going to look at sort of the building blocks of your credit report and credit score in order to build sort of a longer term foundation to have a good credit score, so you won't have to worry about building it quickly. Now we'll get into the tools you can use to build your score more quickly first, because perhaps that's why you clicked on the link for this video to begin with, and then we'll get into some of those more long-term building blocks. The long-term building blocks are really what you should be doing on an ongoing basis in order to have that better score. But if you're trying to get some points on the quick, we will talk about how you can do that. Now, this isn't a foolproof thing that everyone is going to, zip their score up from, 400 up to 700, but these are the ways that you can move the needle the quickest. So your credit score is sort of like a trust score, meaning the people that might give you a loan, the banks that might give you a loan, want to know if they can trust you. Are you going to pay them back? And if you think about what that means, a trust score, it means that they want to know what your history is in order to figure out whether they believe you'll pay them back in the future. Now, the more they know about you, the easier it is to know whether they can trust you. So if you think about it that way as a trust score, then you can think about what would move the needle quickest if I wanted someone to trust me the most quickly. And when it comes to your credit score, there's sort of two pieces where you can move the needle more quickly. All the rest of them are going to take longer, like trust generally does. Now, one of those places where you can move the needle quickly is if you have had some behavior that was not so good in the past. You could change that behavior quickly and in a big way, and perhaps that would show that you have sort of changed your ways if you have done things not correctly in the past. And so the first thing I'll talk about is the idea of paying down your debts, especially credit card debt. Paying down your debt on your credit cards so that it looks like you are using very little of the available credit that you have. So one of the most important pieces to your credit score is how much debt you have, but not just the number in terms of how much debt, but how much debt you have in relation to how much debt you could have. With credit cards in particular, which play such a big part in your credit score, it's what are the balances on your credit cards in comparison to the total available credit. This is called credit utilization. High credit utilization, not so good. Low credit utilization is much better. Now, in most scoring models, the good news is that if you have high credit utilization and you are able to pay down or pay off that debt, you can increase your score significantly in a fairly short amount of time, maybe a month or two, because when credit scores are calculated in most credit scoring models, the way it works is that whatever your debt is on that particular day in terms of what is on your credit reports, whatever that credit utilization is, that is what they are going to go off of. So even if last month you had 80% credit utilization, if this month it's 10% credit utilization, that's what's going to be calculated into your credit score. So being able to pay your debts down if they are high right now in relation to your available credit can really boost your credit score significantly in a fairly short amount of time. All right, quick example. If you had 3 credit cards, one of them's got a $5,000 limit, one of them's got a $3,000 limit, one of them's got a $2,000 limit. Overall, you'd have $10,000 of available credit. If you have $8,000 of charges on those cards, that's $8,000 in comparison to $10,000. That's 80% credit utilization. You're using 80% of what is available to you. If you could pay that down significantly, in particular, if you get yourself under 10%, that could really help your credit score, and it could help it in a very short amount of time. Now, number one, it's not necessarily easy to pay off a ton of debt in a very short time, but if you can, that can help your score quickly. And then number two, for some people, it's not so much that they've got $10,000 of available credit. They might only have, maybe $1,500 or $2,000 of available credit. So then if if you only have, $300 to $500 of charges on there, that's not necessarily a huge amount, but if you don't have much available credit, you're using a lot of what is available to you. If you're in that situation, you might want to consider making multiple payments throughout the month so that when the amount that you have on the cards is actually reported to the credit bureaus, it will look smaller. So if you have a $1,500 limit, you could pay it down to $100 or $200 multiple times per month. So it still reports on your on the credit reports that you are using the card, but it shows that you're consistently keeping it at a low level. All right, moving on, I said at the beginning of the video that a credit score is sort of like a trust score. And if we think about how we gain trust quickly, another way we can gain trust quickly is by having someone vouch for us that is a trusted person. In the credit card world, this is where the authorized user comes in. Having someone that has a good credit history, making you an authorized user on their credit card to show the banks that they trust you, and therefore the bank should have some more trust in you as well. Becoming an authorized user on a credit card is a great way for you to speed the process of increasing your credit score, because what sort of happens is that you gain a new credit card and its history suddenly on your credit report, sort of out of nowhere. So you're not starting from scratch with a credit card, you are getting sort of the whole history of that credit card. Whenever it was opened, the longer it was open, the better. If it has a good payment history, all of a sudden that is going onto your credit report as if you were the owner of the card or the co-owner of the card at least. Now the trick to becoming an authorized user is that you have to have somebody that trusts you who will make you an authorized user, and that's the reason that the banks think that authorized users are an okay thing, because if you have somebody that trusts you enough to make you an authorized user on their card, well then that means that maybe the banks can trust you a little more too. So mom, dad, sister, brother, spouse, whoever that you know who might put you on their card as an authorized user, that can really help your credit score. Now when you become an authorized user, what they're doing is they really are vouching for you, because they are the ones that still have to pay off that credit card. So if they were to actually give you that credit card number and you went off and ran up that credit card, it would still be their responsibility. So they are putting their trust in you a little bit. Now you could become an authorized user and never actually get the card, never have the credit card number, and it could just help your credit score that way, which is the way that many people do it. But the way the banks look at it, the way the credit reporting agencies look at it, the way the FICO credit scoring models look at it is that when you are an authorized user, all of a sudden you have the good aspects of that credit card show up on your credit report, and that can increase your score quickly. All right, so lowering your credit utilization and becoming an authorized user on a credit card that has a good credit history, those are the two fastest ways for you to be able to add some points to your credit score. Now you'll see some other videos out there and other information out there talking about how to increase your score fast. But for the most part, any other methods that are being talked about might help increase your credit score, but they're not necessarily going to do it all that quickly. So what we're going to do from this point on in the video is talk about the building blocks of your credit score and what to do over time in order to increase your score to a place where it's pretty rock solid, and it's not going to have to, you're not going to have to do anything to increase it quickly, or it's not going to fall very quickly either, because you've done the right things over a long period of time. Real quick here, when I talk about credit scores in this video, I am tending to focus on FICO scores. FICO is the company that started the credit scoring model. Their credit scores are the most widely used by the actual lenders who are going to give you loans and credit cards. There is the Vantage score model that is the competitor to FICO. It is not used as widely, but it is often out there as a free credit score that you can get your hands on. So when I talk about FICO credit scores, I'm talking specifically about FICO credit scores, even though a lot of what I talk about is going to be relevant to the Vantage scores as well. But if you are getting free Vantage scores, you might also want to try and get yourself a free FICO score from some of the credit cards out there that offer them, or other services. All right, FICO tells us that your credit score is made up of 5 components distributed roughly in these numbers: 35% to your payment history, 30% is amounts owed, which is that credit utilization piece, 15% is the length of your credit history, 10% has to do with new accounts that you've opened, and then 10% is your credit mix. We're going to look at each aspect of those, talk about what it means and what you can do about it. All right, number one, the most important piece to your credit score is your payment history. Do you pay your bills on time? If you pay your bills on time, especially over a long period of time, that is going to help your credit score a lot. The thing that is most important to know about the payment history, though, is if you screw up, it can hurt you for a very long time. It's very, very important that you pay your bills on time. Now, when I say on time, that doesn't necessarily mean that you are going to kill your credit if you send in your payment today and it was due yesterday, and so it ends up being 2 or 3 days late. Yeah, you might get a late charge, and that's not going to feel very good, but that's not going to get reported to the credit reporting agencies if you are 2 or 3 days late. What's going to get reported and what's going to hurt your credit score is if you're 30 days late, if you're 60 days late, if you're 90 days late. And once you have had that reported on your credit report that you have been that late, that's going to stick on that credit report for 7 years and hurt your credit score all the way down the line. Now, if it was 6 years ago that you did it, it's not going to hurt as much as if you did it, just last month. But that is still something that you should take into consideration. You do not want to have any of your bills sit and be so late that it shows up on your credit report. All right, next at 30% is amounts owed. Now, we've already talked about that credit utilization piece and how that works with your credit cards, but you might also have the question of installment loans, because if we talk about credit utilization and you have a mortgage or you have a car loan, if you had a car loan or something for $12,000 and you hadn't paid any of it off yet, that would look really bad in terms of credit utilization. But that's kind of not how it works in your credit score. There's sort of a wall between credit cards and open lines of credit and installment loans. And it makes some sense because installment loans usually are things where you are buying something that you don't want to lose. You don't want to get kicked out of your house. You don't want to get your car taken away. And you have these payments that you have agreed to make every single month over time. You kind of know exactly what you're getting into with the installment loan. It is treated differently in your credit score. You think about credit cards, they just give you a big old credit line and you could run it all the way up to the top if you wanted to. So being able to sort of control yourself with that open line of credit is seen as sort of more important in some ways in terms of your credit score than those installment loans. Those installment loans do help your credit score if you make all your payments on time, and they obviously can hurt you if you don't, but they are walled off from each other. All right, so that payment history at 35% and the credit utilization, or the amount of debts that you have, at 30%, you put those together, that's roughly 65% of your credit score. When we drop down to the next piece, this is only 15%, and that's the length of your credit history. Now, you might look at that and think, well, there's nothing I can do about the length of my credit history. It is what it is. Whenever I opened my first account, that's how long my credit history is. But it's a little more complicated than that, because it's not just the length of your credit history from when your credit history started until today. It also has to do with two other aspects, one of them being the average age of all of the accounts you have, and then the other piece being the age of the newest account you have. So they are going to look in the credit scoring model at what your oldest account is, but then they're also going to look at the age of all the other accounts and kind of get a feel for how long you have had credit, how often you get credit, how new the credit is that you have, or at least how new some of that credit is, and sort of put those all together into that calculation. So if you have multiple accounts that are older and not very many that are new, that's going to be better than if you have maybe one old account but you have a ton of new accounts. All right, now the next piece that follows from this at 10% roughly is new accounts. New accounts means new credit card or loans that you have opened in the last 12 months, and it also means hard inquiries on your credit report, meaning even if you went after a credit card and you were rejected, that can hurt you as well. Now, the thing about new accounts is, and this is also true of the length of your credit history, even though I said those were 15% and 10% of your credit score, they might be more for people that don't have a very long credit history and less for people that do have a longer credit history. Because if you don't have as much credit history, everything you do has more of an impact. So they're going to look closer at the things you have done recently, where if you have a very long and good credit history, opening new accounts is not really going to hurt you very much. And if your credit score is high, if you have a 750 credit score, opening new accounts and getting a ding on your score of a few points isn't a big deal. If your credit score is low, lower, then getting a few point ding when you open new accounts is going to hurt you a lot more. So this is part of what you need to think about. Don't go with those numbers and think they're just set in stone. It depends on your particular circumstances to some extent as to what matters the most, or at least what those percentages are. All right, then finally, FICO tells us that 10% of your credit score roughly is credit mix, which means the mix of types of credits you have. There's installment loans, the mortgages, auto loans, and other things of that nature. And then there are the credit card and credit line type of loans. Installment loans and credit cards are two very different animals, because one, you are paying down a loan over time with fixed monthly payments. Usually the other one, you have this open credit line. I talked about this earlier in the credit utilization piece. It's sort of a different temptation, a different discipline in order to handle each one of those things. And if you can handle both of them successfully, if you're in the process of handling both of them successfully, this can help your credit score. I would never suggest that someone go out and get an auto loan or get a mortgage or any other type of installment loan in order to improve your credit mix. But if in the course of your life you have successfully done both of them or doing both of them now, that can help your credit score. All right, then finally, there's some other tools out there that may help you increase your credit score that are a little outside of what we just talked about. Perhaps the one that is most well known to most people is Experian Boost. And Experian is one of the three major credit reporting bureaus, TransUnion and Equifax being the others. What Experian will let you do is essentially give them some access to the payment history that you have made on things like your cell phone, your utilities, even Netflix has been added over the last year. And even if you're not paying those on a credit card or somehow paying those in a way that would normally impact your credit report, those can actually go on your Experian credit report. Now, you should understand it's only going on your Experian credit report and factoring into your Experian credit score. So you have an Experian credit score, you also have the TransUnion credit score, and you have an Equifax credit score. The things that go through Experian Boost will impact your Experian credit score, but not the other two. So if you go and apply for a new credit card and they use Equifax to find out what your credit score is, you might have a lower credit score with Equifax than you do with Experian, and the Experian Boost will have nothing to do with whether you get approved or not for that card. But if they use Experian, well, then that could really help you. So it's sort of too bad in a way that there's this Experian Boost that's only good with one credit reporting agency. There are some other tools out there that potentially could help you get some of your payments from similar things to utilities and that sort of thing into your TransUnion or Equifax accounts. To be honest, they're not really all that well known. They're third-party tools out there that I'm not really sure about, and I don't know if they're really worth your time to deal with. Experian Boost, no downside to doing it as far as I'm concerned, but if you have a third party that is not one of the credit reporting agencies saying that they're going to report to them if you do certain things, in particular having to pay something in order to do it, where Experian Boost you don't, I would probably avoid those just because they're probably not going to have that big of an impact. All right, so that's it. That's kind of where we stand here in 2021 with the state of credit scoring. Not a lot has changed over time, but there are some differences there. And if you are someone that wants to increase that score as fast as possible, look at that credit utilization, see if you can find yourself someone to put you on their card as an authorized user. That's it for this video. Questions, comments, put them in the comment section below. Otherwise, thanks for watching. And as always, please go to proudmoney.com, where we do credit card reviews, we talk personal finance, we talk deals, and all sorts of other fun stuff too. Thank you for watching. Bye.